Right now, it's time to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff's also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. But we also want to bring in our first guest, a good friend of the income generation, Harry Dent. He's the author of 0 Hour and the editor of Economy and Markets, a free newsletter available at harrydent.com. Harry, thanks so much for being back with us on the show, and Happy New Year.
Yeah, glad to be here, David.
So, okay, I know you were thinking there'd be a pretty good pullback in the markets, maybe as much as 40% or more, even in 2020. And I was concerned also for a good part of 2020, but it seems like the market's trying to make a liar out of both of us. So what do you see moving forward now in 2021 regarding the markets?
Well, it's just politics as usual, where, especially transitioning here from presidents and everything, everybody wants to keep the economy up and looking good. Trump wanted that $2,000 stimulus check to make sure it didn't fall apart just as he's leaving office, which he gets blamed more for. And of course, Biden wants as strong as possible. But again, the markets are getting stretched. And what I've seen really quick, David, ever since the first bubble peak in early January 2018, every correction has gone deeper and every new high has gone higher. And this is the last new high I see. And the next correction on the S&P would be about 44%. We're at almost 3,800 recently, and I'm projecting 2,100 by the middle part of next year, June, and perhaps as early as early April.
What do you think's going to be the next actual trigger, though, that causes that?
Well, we just kind of saw it a little bit this morning. ADP comes out, payrolls are less than we thought. Yeah. People don't get that this economy's been stretched and stretched and stretched. And we've had the greatest stimulus ever in the last year. I mean, 3.6 trillion in monetary stimulus in about a year since the repo crisis. And now 3 trillion in rising in fiscal stimulus. This is 35% of GDP that's just been given to the economy. Of course, they're replacing a short-term depression, and you can't keep doing this. I mean, the deficit's 3 trillion plus this year, going to be 4 trillion easily this year. And you can't keep doing this. It costs so much. So I say what happens here, the economy keeps weakening despite the stimulus. It's pushing on a string after point. You can only get people to refinance their homes at lower rates so many times. You can only pump up them to spend more when they don't need much and their kids have left the nest. So I think the economy keeps weakening into February, March, the first quarter. And then the stock markets, which is so highly valued, and real estate finally said, well, wait a minute, it doesn't really seem to matter. We just saw the biggest stimulus program by far in history, and we're already weakening again. And that's what I've been saying. It takes escalating stimulus exponentially more to get less and less, diminishing returns, well-known concept in any addiction or growth process.
Well, Harry, you're right. We are pushing on a string, and that string is getting really, really thin. But looking at the market charts today, I mean, it's clearly we're in a bubble. Valuations are stretched. We're going to face some challenges going forward. And now we've got this new political theater action going on. It looks like the Senate's going to be blue.
Well, what's happening now, and this is why the market, I mean, we're talking on Wednesday here, and we get this news of 2 Democratic senators likely, coming in, which is going to take away McConnell's power substantially. And what do? The NASDAQ is down 1.5%, 2%, and the small caps, the value stocks, are up 2 to 3%. Well, it's saying we're switching more from monetary stimulus, which favors all financial assets, especially the most highly valued, which means the tech stocks, and into fiscal stimulus, which actually goes into the economy and the consumers and businesses rather than just into pumping up financial assets. So that's the shift here. So the Democrats think, okay, yeah, we're going to get more fiscal stimulus, but the Fed is going to use this as an excuse.
So Harry, we need to take a quick commercial break. And when we come back, we're going to ask Harry Dent what he thinks about interest rates moving forward and if we could creep into negative interest rate territory here in the United States. So stay with us. We'll be back in a moment here on The Income Generation. Right now, it's time to bring in my good friend and co-host, Jeff Small, as well as a good friend of The Income Generation, author Harry Dent, editor of the Economy and Markets free newsletter, which is available on harrydent.com. So, Jeff, I know you've been chomping at the bit to ask Harry more about interest rates in general. So take it away.
Yeah, my bit is all chopped off, Dave. But Harry, I've got something for you. Going back to the pushing on the string type theories, I see us going forward in the economy using a China money management or financial engineering style of just money printing endlessly. We're going to open up the checkbooks. They're going to buy equities if the market crashes. They're going to keep interest rates low. How can the government ever raise interest rates? How can the Fed ever raise interest rates when there's this much debt? I see interest rates being low forever.
Well, they're going to do it until the markets raise interest rates because of default risk, first in business, and then at some point. I'm projecting in my most recent newsletter a $40 trillion government debt in the U.S. by 2024, because we just had $3 trillion, add $4 trillion a couple of years, and after that, this happens quickly. So the markets will take care of this. But near term, interest rates are going up a little bit. Late stage inflation on the treasuries, 10-year and 30-year treasury, which is important because that is the safe haven in the downturn. It was in 2008. It will be now. It will not be gold. Gold will go up at first. But when you see deflation and companies failing like Lehman Brothers in mid-2008, interest rates are going to go down, Jeff, because of deflation in prices, negative consumer price inflation, not just because of stimulus and buying bonds to push their rates down. So I see the 10-year maybe going up to 1.25 here. It's already up above 1% on Wednesday here, and then going down to 0 or negative 30 years from 1.7 or 8 down to 0.5% or lower. And people say, well, how can you make money on a bond that low? A 30-year treasury bond, if it goes from 1.7 down to 0.4, which is my best calculation, will appreciate 40% while stocks and everything's crashing. In the one thing the U.S. government will make sure to make their payments, they will not screw their own bonds, okay? They'll let the stock market crash, but they're going to pay off their bonds short-term and long-term. And those rates are going to go down and favor them for a while. So this low interest rates is artificial, but we're also in a longer term era of low inflation because of slowing population growth here and around the world. So even when we go in the next boom, we're not going to see inflation go up to 15% again. We might see inflation get back up to 2, treasury bonds up to 3 or 4.
Harry, will we see negative interest rates here in the United States?
I think you could. I think you're going to see that or close. I do think the 10-year treasury, which is the benchmark for stock valuations and lending and everything, is going to go down from about 1% today to around 0. It could go negative. I don't think the 30-year goes negative, and that's the bond to buy because it will appreciate the most in deflation because of the longer duration and the higher rates to start. But yes, I do think we're going to see 0 or negative, and we're the last country. Japan and most of Europe already had negative rates.
Yeah, it's funny. You're the first economist that we've had here who actually says it's possible for negative interest rates. Jeff and I believe it's possible, but most of our guests have said they don't believe it is. So I tend to side with you. But our viewers and listeners are they're retired or near retirement. So when we get this big stock market drop that you're looking for, how long do you think it'll take before things come back? In other words, how long will the market be underwater? They need to know that.
Yeah, it's classic. This is like the 29 to 32 crash. The 90-year cycle is the most important cycle. Nobody sees it because it's so long. This is 29 to 32 happening all over again. Stocks are going to go way down, so you wait and you buy them when they're down. I am projecting and have all the way back to late 1980s, projecting the bottom of our lifetimes in stocks would occur at the end of 2022. So that's about 2 years from now, okay? Because there's a lot of cycles that play into that. But once you peak like we did, started to crash in February of 2020, the Great Depression stock crash took 34 months from top to bottom, almost 3 years. So that would be from February of 2020 into late 2020 to December 2022 would be my best time. That's when you look for a bottom. And I've got a target on the Dow. It's scary, 5,000. When you see 5,000 and or December 2022, that's when you look to buy stocks again. Until then, get in the safest AAA corporate bonds and the 10 and 30-year treasury, particularly the 30-year. Because and you're going to not just get tiny interest, you're going to make money. It's the only thing that goes down when real estate, commodities, and stocks, all other financial assets, including gold at some point, will go down in this sort of reset. You got to remember, this is an unprecedented bubble, only once in a lifetime, every 80 to 90 years, and there is no safe investment other than really safe investments. So you have to protect your money first, and by being in those safe bonds, the appreciation on those bonds is going to give you far more income than the measly 1.7% on that 30-year treasury.
Yeah, well, of course, when you have the 30, you're right, the 30-year is the one that's going to appreciate the most when interest rates go down. So, Harry, it's been our pleasure. It's great to get your views as usual. And thanks so much for being back with us here on The Income Generation. Coming up after the break, are there some potential benefits of permanent low interest rates? We'll be talking about that coming up in just a bit.